Welcome again to this morning's Fireside Chat on investing in Asia, opportunities in the largest markets and beyond. We're very happy to have with us this morning Francois Pictet, Managing Partner of the Pictet Group. So the Swiss bank has over $600 billion in AUM across wealth management, asset management, alternative assets and related services. Pictet started investments in private equity in 1989 and recently launched thematic funds focused on technology, health and the environment. So Francois, thank you again for coming on this morning. I think we'll jump straight into it. Now we've heard quite a bit of discussions, but I just wanted to hear from you, from an LP's perspective. We had a really stellar 2021, but how differently is 2022 turning out to be?
So I think we've just heard quite a bit of it, so I'll be brief, but we can see that the environment is much tougher today than it used to be just a few months back. But again, some of the most established funds are still fundraising quite rapidly, significant amounts, and some of the lesser well-known names are taking more times, having more difficulties. We've heard some of the challenges. Obviously, the point that we've just heard on the fact that all the public assets have suffered quite a bit on a relative basis. The private assets allocation has risen, and maybe some of the LPs are reviewing their allocations. So that's an important point, definitely. In terms of deal making as well, I think uncertainties have hit the investor confidence quite a bit. So we are basically adjusting to a new world with some very radical shifts in terms of interest rates, in terms of inflation, supply chain, geopolitical tension. And I think this creates a gap between buyers and sellers. So there is this valuation gap at the moment that explains why there are less deals happening as a whole in the region and globally, I would say.
Right. I just wanted to look at the other side of the picture then, on the other hand. Have the challenges thrown up particular opportunities then that investors such as yourselves are looking at?
Yeah, I think as we've heard also from the previous panel, difficult equity markets have often been linked or followed by very good vintages in terms of private equity. It doesn't make it a rule, but it is a reset in terms of valuation that can be attractive for long-term investors. Now there are several ways of looking at it. I mean, you can have some more co-investment opportunities from GPs who are invested in companies that are consolidators in their markets and therefore want to reduce their entry multiple by making acquisitions at lower multiples. So that's one. I think there are other ways to look at it as well, maybe further down the line, some more secondary opportunities, obviously. And I think for some investors who are willing to invest more, there may be some more co-investment opportunities in case some of the GPs are struggling to finance some of the deals or fundraising enough for the time being.
Right. At the same time, though, I mean, again, from an LP perspective on fundraising trends, I just wanted to get your view on, how do you look at sort of fundraising cycles getting compressed and fund sizes that are also expanding aggressively despite all that's going on?
As an LP, we don't like seeing those trends. And we are having a little bit more than 60 GP relationships. And with those 60 relationships, we have roughly 45 we are sitting at roughly 45 advisory committees. And each time we see those, the next fund target size, or if we see that they want to come back too early or very quickly, we push back and we challenge that. So we've been doing that because basically this is a trend that is being supported by very good investment environment. But obviously, as soon as exits are more difficult to come early, all these trends will disappear. So I think naturally now funds will take more time to come back to the market, and they will raise funds that are at the same size as the previous one, or in some cases smaller sizes. So that's what we are seeing.
Right. Just to follow on from that, then, what are the key considerations that you have when making new allocations or backing existing managers? I mean, is it preference for existing managers, or how do you form new relationships in that sense?
In terms of the criteria, I think it's private equity is a people's business. So we need to have the best managers, the best investors to partner with. So that's the key criteria, and we need to know those people and how they invest and what's their investment philosophy, their investment style. And there, I think existing relationship have that advantage that we know the investor profile better, especially if we had the opportunity to do co-investment with some of these GPs. We can have a peek behind the curtain in terms of seeing how they work and getting to know them better through cycles. So I think existing relationship will prevail. And also because, the more you add in terms of relationship, probably the less deep you can go into those relationships. So I think you need to be diversified, but not over diversified. Obviously, the criteria are around performance throughout the cycles. It is the stability of the team. It is the ability to generate value in any environment. The way the GPs will look at investments that have been struggling, the resources that they are using outside of pure investment financial leverage. I think is also key. ESG is a factor, but many other levers that GPs have.
Just wanted to pick up on what you mentioned earlier about, pushing back a little. I'm just wondering if we could talk a little bit about how the dynamics between LP and GPs have evolved, over the last few years, and if the pandemic or other crises have had an impact.
LP-GP dynamic, you know that very well. I think, first of all, LPs have been willing to invest and commit more and more over time. LPs are more demanding in terms of information, more regular information as well, on different topics. ESG topics definitely coming up more and more. I think one other trend as well is that some of the LPs are now becoming GPs themselves. At Pictet, we are doing primary investments, we are doing secondary investments, and we are also doing direct investments now for private equity, real estate, and we are starting private debt and private equity. But here, I think it's all about making sure that you manage the potential conflict of interest. So you need to pick a niche where you don't have competing GPs, where you have an angle that some of the GPs you are working with don't have, and make sure you manage those. But those are the few thing I would say about the relationship between GP and LPs.
You mentioned ESG, for example. No, just wanted to ask you, as this increasingly becomes, more center stage ESG issues, as it were, how do you then sort of assess the ESG alignment of GPs?
I don't think it's very original, but we're sending out questionnaires during the due diligence and then resending those questionnaires on a yearly basis to make sure that we monitor the progress made by the portfolio companies. And I think one of the challenge on ESG is that it's very difficult for LPs to compare how GPs are doing versus one another. So we've been one of the eight founding LPs in the ESG data conversion initiative to make sure that we have some kind of standardization of how the data is being collected, so that we can compare and start comparing how GPs are doing. I feel that probably the topic is more sensitive in Europe and in the US than it is in Asia. But it will come here as well, definitely. And what we are asking our GPs is that they have at least one person 100% dedicated to ESG matters. So this is becoming a hard requirement, and not only nice to have.
Yeah. The other thing you mentioned is LPs are increasingly become GPs themselves, just to understand what's driving this.
I think it's all part of this, this intermediation play that we're seeing. And in some cases, having worked with GPs for a very long time, having done a lot of co-investments with them, we have developed certain skill sets and understanding for the asset class. And in some cases, we identify niches where we have actually an edge for us to start thinking about this type of initiative. And obviously, there is the profitability element for the institution that can be successful in going direct.
I wanted to take the last few minutes to come back to, in terms of LP allocations in Asia. How have you seen it evolving over the last few years, for that matter, and also Pictet's allocations to the region?
So I think the allocation towards Asia is increasing, definitely. And I'm not talking about the last few months. I'm just talking about that general trend. There is some catch up to be made. That's true that the industry has a shorter history than it has in other regions such as Europe and the US. So there is some catch up. There is so much value being created in Asia. So we are seeing more and more interest. I think maybe what has been the challenge in the past was to find LPs that have been around for long enough, that have been around throughout cycles, so that LPs could feel comfortable that these GPs would do well during the next cycles that they would go through. And that's why I think it took a little bit of time, but very promising markets on Southeast Asia and in India that is being more talked about now, that maybe currently right now China's uncertainties are making that market a little bit more tricky.
If we could just flesh out a little bit in terms of your view on opportunities in India.
Yeah, no, I think India, and I would put it almost in the same bracket as Southeast Asia. Those are markets where there is tremendous value creation, great demographic trends under Modi, all the good economic reforms economically speaking, have been addressing some of the most problematic structural challenges. And I think we are seeing more and more good deals coming out of India, and not only on the growth and tech sectors. So it's becoming more and more generalized. But one thing I would say, and we've heard that as well in the previous panel, I think private equity is very much a bottom-up process. It's nice to have all these macro data points supporting you, but if you don't have the right deal team in place in India, you're not gonna do well. And the same, I mean, we've been working with GPs who've been in India for more than 10 years, and they didn't do any good deals until they got the right deal team. And then since then, they have been doing extremely good transactions in various sectors. So I think private equity is very much bottom up. It's very much idiosyncratic situation. So one should not overreact to a region, to a country, to some of the short-term news that are around, because there are always opportunities for smart deal team to take advantage of.
Right. I think last question, if we could just talk a little bit about China. I mean, you mentioned briefly. What is the view on China then from you?
I think the view, as I alluded to a little bit earlier, I think the view is that currently there is that valuation gap. Given all the uncertainties in terms of regulatory reforms, that they come from a good place, but I think they lack consideration for investors and entrepreneurs, and they've had a big impact in terms of knowing and private equity investors would need some level of predictability, and right now, in a very much evolving world on many fronts. I think now the challenge is that there is that valuation gap between buyer and seller. So I think long term the story is still intact. It's just about when will people feel comfortable. If you think about how you're going to model your assumptions, what kind of interest rates should you have? What kind of inflation assumption should you take into account? What kind of supply chain issues? How do you put all the current geopolitical tension into the equation and get with a level of confidence that is high enough for you to pull the trigger on some of these transactions? So I think GPs will be very disciplined in terms of how they look at a new transaction in China, and they will probably focus more in areas where they feel there is less regulatory uncertainty. I think hard tech, manufacturing, climate are probably a good place to look at, because this has hurt investor confidence. I mean, the recent reforms in terms of policies.